105 on the East Coast. It's my fault, people. If you want to send a hate, send it my way. I was, impaling myself technologically wise. But this is Market Call. Today's Market Call brought to you by FactSet, financial data and analytics powered by tomorrow. And of course, if it's Thursday, it's SoFi. Get your money right all in one app. Elizabeth Young is in the studio. Dan Nathan is in the studio. I am not. And in just a few minutes, back from wherever the hell he was, not that he will be with us, but he's always sort of with us, Butters. I think he was like in Michigan. Who goes to Michigan? People from Michigan don't want to be in Michigan.
Oh, guy,
they got
a lot of beautiful lakes. Yeah,
honestly, they really don't.
What, Guy? This time of year, we're in New York. I think without doxing Butters too much, that would be John Butters. He's a senior earnings insight analyst.
Did I just do that to him? I doxed him.
Yeah, but he's up there in Boston. It's hot this time of year, isn't it, Liz? Right now in New York City, it is absolutely disgusting. Yeah. Guy and I, we were part of a bell ringing ceremony at the NASDAQ this morning. They do have a bell. They have an opening bell and they have a closing bell. And we did it. The opening bell, the Fast Money crew. It was awesome. But then they took us outside because they put all our pictures and all this stuff up on the outside of the NASDAQ. And Guy, we're, as our people say, schwitzing a little bit. It was hot to be in a sport jacket or a suit.
I bet.
Yeah, was not pretty. But we got a big show. We got Liz in the studio.
Yeah.
Guy is in his home studio. We're just gonna call it Guy's skiff. That's what they do in the government, right? Skiff. It's like the thing where you read
your location.
Yeah, exactly. But we got a lot going on. A lot of things that we have been talking about on Market Call that Liz has been writing about. We talk about it on the tape with our good friend Danny Moses, who's also in the house. It's kind of coming fruition, Guy, and we still have a VIX that's like 15, right? Like, let's just talk about this. We're gonna get into the Apple stuff. We're gonna get into the China stuff. I think we've all been thinking like Apple is going to be the last battle fought in an economic war between the U.S. And China. They seem to jump the gun a little bit here, Guy.
100%. Before we even get into it, Mike is asking for question for Elizabeth.
Oh, boy.
Guy, I need you to ask Liz a question. Apparently, you must block him or something. For his Oktoberfest, which I guess is in October, should I have Usingers or Johnsonville Bratwurst?
Okay, so I believe Usingers is still the official sponsor of sausage for the Milwaukee Brewers. I have always been a Johnsonville gal, but either are fine. But it's pronounced Usingers.
Okay, what do you want me to tell you? I've never heard of Usingers or Johnsonville.
Guy, what you should do is watch a Brewer game sometime, a home game, and watch the sausage races. Actually, I think those are Clement sausages.
I have seen that, and I think your Brewers are coming to the Bronx soon. And
heard that.
Oh, by the way, what's interesting is, some of the comments today are great. I won't even get into it, but let's talk about
all right. Well, let's talk about it. You've been talking about China a little bit in your notes, your commentary and the like here. Things just kind of got ratcheted up pretty good here. And the fact that the Chinese, listen, we've been talking about chip bans, like these advanced chip bans for a while. I think the Biden administration, put some efforts in place August, September of last year. The whole idea, this has been going on for years, the idea of banning TikTok, right? So now the Chinese are saying iPhones are going to be banned by government workers, that sort of thing. That's a huge escalation. That being said, I'd be surprised if that many government workers in China are using iPhones. And that was the same argument about some of the other stuff that we've seen. There was also Tesla when President Xi went to some city recently. They were banning Teslas from entering that cities because of their ability to track different, data and LiDAR machines and that sort of thing in there. So what does this kind of mean to you as far as the rhetoric as it relates to China? And then we'll definitely talk about Apple specifically.
Well, one of the things that we've been talking about, I know I mentioned this a few weeks ago, and I made some really strange analogy with cement and
you did.
My family member had a $55,000 driveway. But the point was, whether you think you're invested in China or exposed to China or not, you are. If you're invested in Apple, This is a perfect example. You are exposed to China. You are exposed to the risks that China presents. If you are invested in really any broad market ETF, you're exposed. If you're invested in materials, you're exposed. If you're invested in any emerging markets fund, you're exposed. And if you're just alive, you're exposed to China. So this stuff matters. It hasn't necessarily come through in the broad markets. It has certainly not increased fear broadly or scared investors yet, but all of this stuff will continue to add up. Not to mention, now there's this theme that is global about debt and credit and issues in debt and credit. In the US, it hasn't come to fruition yet, right? We've got credit spreads still so tight, high yield and investment grade. That, to me, that feels like a rubber band that's just being pulled further and further back. China now, obviously, debt issues. We've been talking about debt issues in China for a long time, but now they're coming to the surface. Nobody knows really how that's going to ripple through, but if and when it does, again, this is something that every investor will end up exposed to, even if just on a sentiment level.
So, Guy, you've been talking about this for years. The amount of ETFs that hold Apple, is the largest, equity. It is the largest equity on the planet. And just 3 days ago, it had a $3 trillion market cap. And these headlines have caused, nearly $300 billion in market cap to come off it. That is crazy. Our friend Doug Cass over at Seabreeze, who writes for Real Money, he's been writing on this. He's been shorted, I think, since prior to the earnings results. But just think about that guy in market cap terms. And he was also highlighting the fact in his note this morning of these 915 million shares that Berkshire Hathaway owns, right? And a lot of big pension funds, they've been hiding out in this stock for years, Guy.
347 ETFs, I think, last I looked, and don't at me if I'm off by a few. Apple is one of the top 15 holdings. So think about that. It becomes its own asset class. A lot of people have said that. That's not new on my part. But when the passive investing, the passive investing, I guess, whatever else you want to call it, I mean, it's what's taken the market by storm over the last 5 years. Apple wins to that. So regardless of news, regardless of value, regardless of anything, if money flows in the market, Apple is going to win. But guess what? It works on the other side as well. So if people start waking up and say, wait a second, I didn't realize they had that risk. And don't kid yourselves. I mean, this is a salvo without question by the Chinese. It's not the first and it won't be the last. I mean, this rhetoric will continue. And it's not coincidental that it happens on the heels of Gina Raimondo being over there and trying to obviously mend some fences. There are no fences to be mended. I mean, this relationship is broken, and this is again my opinion. It's only going to continue to get worse. And people say the Chinese need us more than we need them. Maybe. Problem, of course, is the Chinese play a long game, a 25, 30, 50-year game here in the United States, and you can throw the hate all my way you want. We play about a 5-minute game, and almost by definition, if that's the way the battle lines have been drawn, it's very difficult to beat that adversary.
Yeah, and listen, we've been talking about this, it feels like, for a couple years now, and since the trade war started with China, years and years ago, I guess it was 2018 or so under the Trump administration. I mean, Apple will be that last battle fought, and it has a lot to do with, obviously, the orientation of their supply chains. Most of the hardware that they make, comes from China, so they rely on Chinese labor, and they also rely on the Chinese consumer, the emerging middle class, to buy increasingly aspirational, devices and the like, and that was Apple. Now, all that being said, when you think about WeChat and you think of these, super apps as they call them, most of them run on Android, right? And so Apple still has very small market share as it relates to iPhones over there. But we've said that the nationalistic tendencies that can be dictated by a totalitarian government in a country like China is going to take hold at some point. And it also means the same thing for Tesla. So it's not just reorienting as a matter of national security away from an area like China, which Apple is clearly doing. They're making iPhones in India, and that was a big story over the last couple months. And we also know that Tim Cook has spent some time in India and Indonesia and other countries, and so has Elon Musk. So again, this is a story that is going to keep, it's not going away anytime soon, Liz. And 20% or so of their revenue comes from China, and this is a company that is expected to grow sales, maybe mid-single digits. They have all of the gross margin in the smartphone industry, but think about that. If they have to reshore the manufacturing of a lot of these phones, then that means that their margins are going to go lower. And the premium that you pay 27 times for, let's say, mid to high single digits earnings and sales growth for a company whose cash balance continues to dwindle, you know what I mean, relative to its debt, and if its market cap will go lower, it's just not that interesting at 27 times. So I'm not asking you to opine on the stock in particular, but if you want to use this as a proxy for U.S. multinationals who are depending on Chinese for a whole host of things, it's not a great situation right now.
Right. I have a dumb technical question first. So, and this is
what do I look like, the geek squad over here?
This is an easy way for me to not talk about an individual stock, but get you guys to talk about it. I can't see what's up on the screen, but if we can go back to the first chart on Apple where it showed a gap down. My question is this. So usually when a stock gaps up, right, we talk about the fact that it's inevitable that it back and fills. When it gaps down, does it front and fill? What's the trajectory of the price?
That's fair. And if Jacobs wants to pull something up real time, so you can go back and look at where the prior all-time high in Apple is. Obviously, we just made an all-time high recently, had that draft lower on the back of earnings, which should have happened. But the level we're at right now, sort of this 176, 177 level, this was basically the prior all-time highs from the fall of 2021. To answer your question, yes, we've created a gap with this gap open lower, and those gaps are typically filled. Really, the question is, though, at what point is that going to happen? Gaps can remain gaps for quite some time. So, we're at these levels now where it's going to get really interesting really quickly with Apple. As Dan mentioned, this is an expensive stock, especially in an environment where interest rates are going higher. So I am definitely concerned because people say as Apple goes, so goes the broader market. I want to address good question here before I lose the DoubleClick is asking, Guy, how do you square your bullish call on oil with your concerns for the general economy? I understand supply side discipline, but inflation picks up with more hikes. Doesn't that destroy demand? It's a good question. I think a lot of that move to the downside and all down to 65 was predicated on a slowing China, those types of things. But I think what you're seeing with this subsequent move higher, a couple things. It's a supply side issue. And listen, Halima Croft, we're going to have her on our podcast. She speaks to this. There's still a lot of people that would say, in this economic environment, understanding things are slowing down, oil should be higher. And I think that's what you're seeing. So yes, I'm bullish in oil. No, I'm not bullish in global economies. And I think those two can square. Back to you, Dan.
So I want to talk about this oil thing for a second. I think part of it too, at least for me, is a time horizon thing. And you have to remember, first of all, in my column this week, I talked about big concepts, reviewing them for back to school. This is another big concept to review for back to school. So I am also bullish oil prices, but more so in the short term. What's one of the things that usually happens before the economy contracts? Or what's one of the things that usually happens before markets see a lot of broad volatility? A spike in oil prices, right? So if this turns out to be such an event, the rise in oil, maybe this sort of orderly rise in oil prices could continue or spike up before we get what I think most of us at this table and Guy, you at home in what's it called? A
skiff.
A skiff.
Yeah.
Skiff.
Are expecting. So a spike in oil, a rise in oil prices actually would be characteristic of this time in the markets, given our expectations. The other thing I would say is we talk about energy as a sector, right? Investing in oil is different than investing in energy stocks. Guy can speak to this much better than I can. But energy companies are comparatively really shareholder friendly right now. Still dividends, buybacks going on. Compare that to some of the other companies that are inflated multiples, not offering dividends. Some of the sectors that have seen the most upside this year, you don't really have a place to hide there, right? So energy is in that camp. I would actually also put utilities in that camp.
Yeah, I just say this. So I think that was a great question. And Guy, I was going to ask you that question. So I'm glad a listener did do that, or a viewer. Listen, I am just hard pressed to think that, like from a geopolitical standpoint, our adversaries would love to see crude oil go higher for a whole host of reasons, right? So that is on the table. We had news, this week, the Saudis, the Russians, the Chinese. I mean, there's stuff going on there. Technically, Carter Braxton Worth had a note out, I think early this week or late last week, the anatomy of a trade on Worth charting was really great, just the technicals of crude. And it really does look like it wants to what, Guy?
Party. And we actually discussed that anatomy of the trade yesterday. But yes, continue.
Okay. So all that being said, your XLE, maybe they can pull up a 5-year chart of the XLE. Guy, you tell me, is this thing going to be able to kind of like get back to those prior highs? It's somewhere in the kind of low 90s or something, that 94, 95 or something like that, and bust out from here? I don't know, man. Like I just don't think buying those stocks right here, or the oil services after the move that they've made, or crude at, going from the high 60s, let's say, to the high 80s, and possibly if you look at crude, that mid 90s level, I think they probably top out there, because to your point, Liz, if all of that precedes, economic weakness, I think the market's going to sniff it out, or at least investors are going to sniff it out ahead of time. Thoughts on that, guy? Because are you buying them here? Are you buying energy stocks here? Are you buying crude for the trade?
It's absolutely fair comment. You could say, I mean, I think this is XLE that you have on, right? Yes. So you're looking, we're pushing up to those levels. If you go longer term, if you can do that, Jacob, you'll see where we were. I think at its all-time high was about 101 or thereabouts. So, there's a chance we make that push. The answer to your question, in my opinion, is yes, you can. But I really haven't wavered all that much on energy for quite some time. But I would understand people saying, you know what, it's probably getting a little long in the tooth. And OIH, which I think yesterday or a day and a half ago made a 4-year high at 357 or something. You could say the same thing. It's time to take some money off the table. I'm here to say, though, in a world where valuations are going to start to matter, and in a world where the fundamentals still stack up for energy, I think people are going to find their way into the energy trade, especially if the NASDAQ has a sell-off like I think it's going to have.
All right. So the only thing I'm just going to say is I agree with you. When I look at the OAH and I look at the XLE, they look like they want to break out. I'd rather buy those breakouts in the equities than I would in the commodity, probably for a lot of the reasons that you just listed, Liz, and valuation is one of them, and the way these companies are run. And Guy, you've been pounding the table on these names all year long, especially, after they were just very unloved in the first half of the year. So I get all that. All right. So now folks often say things like, chips are the new oil. You hear that expression, that sort of thing. So going back to a little bit of this tit for tat with China, we talked about the advanced chip bans that started, mid last year or so. Look at this SMH, okay, the ETF that tracks this semiconductor index. Technically, it's coming into a level. I want to throw up Taiwan Semi, which behind Nvidia is the second largest holding in the SMH. This one just broke below its 200-day moving average for the first time, in I think since the spring or so. And we all know, this is a name that we've talked about a lot. If there was any kind of, bigger elevated trade war or any sort of situation with Taiwan, I mean, this is a real, this is a focal point here. Thoughts here, Liz, on this sector in general, very dependent on Nvidia and the sort of excitement in and around AI and the lack of supply for advanced chips. And, obviously we know that story really, really well right now. Taiwan Semi is kind of a different story here. And when I look at this SMH, I see a little bit of an air pocket back to that breakout from the spring. I'm not going to ask you on the technicals, just curious how you're thinking about this space within tech in general.
So whenever I think about semiconductors, I usually try to chart it with software, because you can do a pair chart similarly to the way you can do staples versus discretionary, just to try to figure out if the market is feeling cyclically positive or cyclically negative. If you chart it over a 6-month period or a 1-month period, you'll see that semiconductors have fallen below software. Over the 6-month period, they're just kind of at the cross point. But that tells me that just in these two industry groups alone, the market has started to feel less cyclically positive. Obviously, Nvidia is going to have an outsized effect given its performance this year and then the pullbacks that have happened. But if you look at just the behavior of the market overall, it's pretty consistent with a cyclical pullback, or at least cyclical trepidation, we could call it, right? So whenever I think about semis, I think about that. I maintain the view that something is going to break in the economy. This is not a time that I would be buying semis.
Yeah, Guy, really quickly, maybe the guys could pull up the IGV on its own, and this is an ETF that you've done this in the past for us here. And when I look at the components of the IGV, it's Adobe, it's a nearly 10%. Oracle is up 8.5%. Salesforce is 8%, and Microsoft's about 8%. So if you think of that, like these major enterprise software names are the big components here. And look at that thing, Guy. I mean, that thing has gotten right back. So while we've seen, some semis sell off a little bit, Apple's obviously sold off a lot in the hardware space. old tech, old software is doing the job. Thoughts there?
Mm-hmm. It is interesting when you're going back, and we've talked about this. Oracle's making an all-time high. So the IBM very quietly has been getting off the mat, and
Dell,
probably rightly so. And Dell made an all-time high on the back of their earnings. The stock was up, I think, 18% on that earnings release, which is remarkable if you think about it. I think part of it is, these companies have been left for dead. They haven't been sexy. They don't have the same basically moves that you've seen in some of these high flyers. But again, like energy, I think when people realize that, wait a second, these stocks in a higher interest rate environment, these high flyers are too expensive. They're going to flock to names where they can make a reasonable argument on valuation. And I think that's what we're seeing. And somebody just asked me a question. It's a good question, and I've lost it, so I apologize. But I have said that Taiwan Semi's one of the 5 most important companies in the world. I believe that. I think Microsoft is absolutely one of those companies as well. I think Apple is as well. And I'd have to think about sort of the other two. I wasn't prepared for that. But a reason why Taiwan Semi is the reasons you talk about all the time. So anyway, that's that. But I do think there's going to be a place for these old school technology, and throw Cisco in that mix as well, Dan Nathan.
Yeah, no, it's kind of, we're partying like it's 1999. Where's Lucent and Nortel, Liz?
Somebody put a comment in that says, "Time to go long, Palm Pilot."
Oh, that, what's funny? What's funny? Because I have been involved in all these stupid stocks for as long as I've been in the business. Palm was actually one of the first meme stocks. Like people talk about meme stocks like it's a new phenomenon in 2021 or something like that because of GameStop and AMC. Man, iOmega, do you remember that? You don't.
Oh,
you were like in 4th grade. iOmega was like a meme stock. Palm was a meme stock. Sirius XM, before they merged, both of them were meme stocks, and they merged 2 meme stocks into one big meme stock. So that phenomenon about retail fascination with some of these things. And you know what's interesting about it? They're usually consumer products. They're usually things that retail investors can touch and feel and that sort of thing, and sometimes feel an unusual bond to them. And that is maybe the similar, to GameStop and AMC. I don't know. All right, let's talk about the S&P 500. Guy, when Danny and I were in Chicago for the market call on Tuesday, Danny did a short trade in the S&P futures, and it was really well timed there. We were talking about, that check back to the breakout level from August of 2022, that 4350 level, which it got to about a month ago and just bounced off of there. And he was looking, when the S&P was 4,500, for the initial move back towards 4,300, and then possibly as low as 4,100. Are we making a little bit of a short-term head and shoulders top above that breakout level? And are we likely to see a retest of that uptrend that's been in place since the October lows?
Yeah, it's something that Doug has been talking about. You've brought it up a couple times, the formation. And again, just to reiterate, for the however many times I've iterated it, I am bearish. I think the market's going lower. So I think the answer is yes.
Are?
And
wait, what? Wait, what?
Danny's his levels are spot on. The one thing that I said is, as this, again, if it works the way I think, as the market starts to accelerate to the downside, I actually think he can add to that position on strength and then put in that trailing stop. So it makes a lot of sense. This uptrend line will be tested. That will come in the form of about 4,300 on time decay. At a certain point, the moving average will be tested. Then the question is, what's going on in the background? If rates go up like they think they will, again, I think 10-year yields are going higher. I've said that for a while. The market's not going to like that. The market's going to come to the realization that, wait a second, something's broken here, and the stock market shouldn't be trading where it is.
Yeah, Liz, what about rotation? So to Guy's point, I would have thought on a week that saw Apple drop 8%, Nvidia's drop from 500 to, 456. So almost.
By the way, quickly, and you're going to bring up Nvidia. Listen to what C3 AI said, again, and everybody's, C3 AI basically saying, we're not, I'm paraphrasing, and we can put it in the show notes, but they're not being able to monetize the way the market thinks they should be monetizing. And that's one of the reasons I think Nvidia is under pressure. Anyway, Please
Well,
continue.
but listen, guy, that was one of the reasons that Microsoft sold off 10% after its earnings. It was one of the reasons why, Salesforce also did. I mean, like, listen, we've been saying this, like a lot of folks like to point out, wow, you guys are bears or this, that, whatever. I mean, we're pointing this out. I mean, the likelihood of these companies being able to realize, meaningful revenue right now that turns into profit that doesn't come at maybe a slightly lower margin than some of their other stuff, or it doesn't cannibalize other purchasing of like software. It just doesn't make a lot of sense. It would basically, like turn on its head all the things that we know about enterprise spending as it comes to, software and the like. So, Liz, talk to us a little bit. Oh, look at this Nvidia guy. This one was for you, buddy. And I didn't even tell you this was coming. What do you call that formation right there? You know what that is.
If I had to guess, that looks like a hungry reptilian, probably of the.
Well, we call it the hungry
crocodile.
alligator. And so here's the deal. So what's going to happen to this chart, Liz? So you understand, okay? Because we know that you're, technical.
Not a technician.
No, you're not.
No.
But you're a fine
I don't
market
even
strategist.
I don't play one on
no,
TV.
you
either.
don't. Okay, what's going to happen is that Nvidia is going to break that uptrend, okay? And then the 200-day moving average that's rising is going to get, so when you have the rising 200-day get above that support level or that breakout level,
the jaw
and
of the alligator?
that would be the tongue. Okay,
Oh,
yes. So when
it.
the tongue is the 200-day moving average comes above the bottom jaw, okay, the jaw, and then you have that snarly, you're going to have this little tooth come in to the top of the mouth. That is what Guy refers to as a hungry alligator. We came up with that together. I think that we really workshopped it a little bit. We got it on a whiteboard. Yeah. Carter was not impressed. That's why we're kind of.
I think you go forward with it once you figure out a more simpler way to explain it.
Can I tell you something, Guy? In 2 weeks, this is going to be the most perfect hungry alligator for it. It's going to be like textbook because you're going to have that snaggletooth tooth, and then you're going to have the 200-day moving average. You're going to have the tongue in there. Okay. And that is all right.
Okay.
Sorry.
Great.
So, by the way, go ahead.
I look forward to this alligator.
Yeah, that's happening.
All right.
All right. So to your point, so a lot of the software companies are not able to say that this is happening right now. And Nvidia, listen, people, I'm just telling you, that was it. Okay. That so they had 75% revenue outperformance, then sequentially 30%, and then it's going to go to 10%, and then it's going to go negative, and the stock's going to be at $350. Okay. So like that is what it is, but this is the way this game is played. And I'm very happy of all of you who made, and I mean that sincerely, made a lot of money. I just didn't see it going as long as it did. I was not short this thing the whole time. I think a lot of our listeners, somebody sent me, one of our listeners on the podcast sent me some guy who's trolling me on Twitter who's got a big following and said he's been short Nvidia the whole way. If you watch what we do every day, because we do show up every day, we talk about this stuff. We're very transparent. I talk about how I define my risk using put spreads, short call spreads, that sort of thing to get short exposure. So I would never be just kind of naked short, something like that. Guy, you just mentioned yields. Liz, break it down for us, sister. What's going on with yields here? Because, we don't have a Fed meeting for a little bit here. We know the CME Fed tracker is pricing a pretty decent, September 20th, but then it's pricing a very low probability of a rate increase. And then we have this period in which we don't have anything in October until we get to November. This chart, and Guy's been all over this too, looks like it wants to break out. Yeah. This is the 10-year U.S. Treasury yield.
Yeah. Well, we don't have a Fed meeting, but we do have CPI next Wednesday, and we've got PPI the following day. And with oil where it is, I would venture a guess that it may come in slightly hotter than what people are expecting. And this is that period where, and we've talked about this so many times, we've now passed the peak year-over-year comparisons. These comps are harder, and they will continue to get harder as the year goes on. If there is a moment or even a couple months strung together where we have hotter than expected CPI prints, I don't think the market is going to like that very much. I think people have gotten very used to this sloping downward line that has moved in a precipitous fashion, and the expectation is that it's going to continue to do that. So I think there's a big risk that CPI surprises to the upside, and the market probably has to correct in response to that. I don't think that's going to be enough to kickstart what I think all of us are expecting, but it won't be a good look in the meantime. And then we've got a Fed meeting. I'm at this point where I don't think it matters if they do any more hikes. 25 basis points doesn't matter at this point. It's about the messaging, but it's also about the incongruency with what the market is going to expect and what they might do. And this uncertainty of, are we done or not? I just would rather know that we were done.
So Guy, you've been saying somewhat similar, but let me take a different approach to this. If they surprise the market with a 25 basis point hike after they've been hawkish, okay, let's be clear on that. But it seems like market participants and some very smart ones, including Liz and you, are saying that they're pretty much done. If they start raising again, they're never going to say we're done. Do you agree with that, Guy? And so what I'm saying is like, okay, then we get to 575 on the upper end, right? And then what does that mean for the Dees meeting? You know what I mean? Or the Nova, like my point is, it could have like this kind of self-fulfilling sort of thing at a time where people are kind of fading the likelihood of further hikes by the Fed, although we've seen the 2 years stay pretty well put here, grounded around this time. So thoughts on that if they were to surprise the market, Guy?
Yeah, I think listen, if they were to hike 25 basis points, the market's not going to like that. My opinion, I think people have come to the realization or conclusion, I should say, that not only are they done in the beginning of next year, somehow they'll be cutting rates, which I don't understand why that would be, but that's probably, we'll talk about that at a different point in the show. I will say this, the damage has been done. I think I agree with Elizabeth on this one. Doesn't matter what they do at this point. They've done what they needed to do. It's just now the market's going to deal with the lag effect. I don't want to use this analogy, but there was this great movie, Force 10 from Navarone. They had to blow up a bridge. They weren't able to blow up the bridge. So in order to take out the bridge, they decided they were going to blow up a dam. And they put all these explosives in the dam. They set the explosives off and nothing happened. And they're looking at each other like, why isn't anything happening? And the guy that basically set the explosives off said, let nature take its course. Just trust me. Just be patient here. And sure enough, the cracks started to form. The dam broke. Everybody's impatient. I'm guilty of that as well. But nature's been put in place. This whole thing has been put. The die has been cast. It's just a question now is, when are we going to start feeling the impact? I think that's an inevitability that we will.
Well, the timing, listen to the timing of this too. And I wrote about this in my piece today. All of these people talking about this time is different. It's taking longer. Okay, here's the reality. We are 17 months into the hiking cycle. We are 14 months into a major yield curve inversion. This is exactly the time when it usually happens. So we could get to a point, let's say we're 1 year, 2 years down the road, looking back on this period. And what if we're saying, I think it's likely that we're saying something like, oh, turns out it was exactly the same, not different. Yeah. It was actually in the exact window that it has happened over the past 14 months. Fun fact, 14 months is the average of when a recession starts after a yield curve inversion. This is month 14.
Yeah. And again, we won't know that we're in a recession until 6 months after the fact. Correct. So to your point, it's kind of good chance it happens in the not so distant future. And then the markets start discounting that. And they have not done that at all so far. I just thought it was funny. We started the week with Goldman lowered their recession odds to 15% from 20%. You know what I mean? So there's no recessions ever again. Liz, let's talk about your note really quickly here. They just flashed it up here. It's on the money. You guys can find it on the SoFi investment blog. Liz looks at September markets. Guy, she did not do the thing that I thought she might do to get you kind of exercised. Wake me up when September ends.
Yeah, what? She's better than that.
She
She's
is
so much better than that.
It's in there. It's in there.
Oh, it is?
Paragraph.
Oh, we didn't read it yet.
Yeah.
Well, we were waiting for you to read it to us. So go ahead.
Well, you can just read that little clip there. The first song, though, is that one by Earth, Wind, and Fire.
Okay.
Do you remember?
Oh, yeah. Will you sing it?
So not this time, but there's a bull anthem and a bear anthem, right? The bull anthem is September by Earth, Wind, and Fire. The bear anthem is Wake Me Up When September Ends, right? Who knows which one is going to be right? I like both of the songs. I would lean towards Green Day versus Earth, Wind, and Fire. But what's happening, here's the thing that I did in this note. Back to school, big concepts. Let's not get lost in the day-to-day. Let's not get lost in the weeds and get too overly excited about one or two companies. The reality is we still have to respect the cycle. And I'm going to talk about this from a market perspective very quickly. If we are, in fact, late cycle, first of all, I can't find any indicators that we're not. So I'm quite confident that we're late cycle, but we've been in it for a while. What usually happens late cycle is that large caps outperform. Guess what's happened this year? Large caps have outperformed small caps by about 13 percentage points. Then you get into a contraction. That's when bonds outperform. That has not happened. So the call for the 10-year yield to continue to rise, maybe we're not there yet, but if and when that starts to occur, the bond trade, for those of you that are in treasuries and are invested in them or have been invested in them, yours truly is one of them, that's when it starts to work. And then later, there was actually a question in the comments. Somebody said Liz has recommended small cap value in the past. Does she still feel that way? Not until you get to this part in the cycle, which is early expansion. That's when small caps lead, particularly small cap value, because of the exposure to things like financials, industrials, and those cyclical sectors. So not yet, but I'll let you know when I feel better about it.
All right. I mean, Guy, we got through that without you getting too disappointed.
Exercise. No, I love Liz's work. Come on.
I think you probably appreciate the Earth, Wind, and Fire. You know, I actually, I'm a huge Green Day fan. I've seen them in concert lots.
Yeah, I love the Green Day.
But I've actually seen Earth, Wind, and Fire in concert 1995, July at the Greek Theater in LA. How about that? And I was very pleasantly surprised. That was a fun show. All right. Before we get out of here, so we went from, Liz just said, without getting too excited, this is the moment of the week where Guy gets really excited because John Butters, he is the senior earnings insight analyst over there at FactSet. Guy just calls him hashtag.
Watch people, watch the comment section.
I know the comments light up, and we're glad to have him back. He had a much needed vacation, but actually he wrote his earnings insight blog last week. We did quote it on our On the Tape podcast. This one was great, man.
Hold on a second. Before, I know you want to introduce Butters properly, so do it. But what is a Chumbawamba? Is that a band?
Wasn't there a song, Tub Thumping?
I don't know, because some guy is saying that I wear a banana hammock to Chumbawamba bands. I don't know. So sorry. The comments in it's just so good. Anyway, sorry.
I know. I wish we could turn them off.
Yeah.
All right. So this week, John Butters, senior earnings insight analyst over there at FactSet, who writes the earnings insight blog. We get a preview of it on Thursdays on the Market Call. It drops Fridays. You go find that at the FactSet investment blog that they have over there. This week, talking about something that I thought was really interesting because we know that we are done with S&P earnings for the Q2. He's talking about how often the term AI had been cited in Q2 earnings calls. 177 S&P 500 companies did just that. This reflects the highest number in the last 10 years and 51% increase compared to the prior quarter. The information tech sector has the highest number of percentage of companies citing AI on Q2 calls. The S&P 500 companies citing AI on Q2 calls has seen higher average price increases in recent months compared to the S&P 500 companies not citing AI. All right, Liz, talk to me about that. All right, so we've been hearing a lot about this. I do think it's interesting that quarter over quarter from Q1 into Q2, they saw a 51% increase. And listen, I'm sure Butters has a treasure trove of data. He's been doing this and tracking this sort of stuff for a very long time. Whatever is the buzziest thing, I bet he was writing about Web3. I bet he was writing about, like a whole host of other trends, blockchain and the like 5 years ago, that sort of thing. So talk to me when you see data sets like this. It is interesting. It does speak a little bit to the psychology of investors if they're willing to actually give some credit to the fact that companies are speaking to these trends.
Well, and I'm sure companies, I know companies think through this more than what I'm about to suggest, but it feels like, especially looking at a chart like this, and those of us that listen to everything that companies say and follow it, it feels like they all kind of looked around and said, oh, wait, somebody found the fountain of youth. Somebody found the fountain of revenue and the fountain of multiple expansion. Let's figure out a way to talk about AI. And the types of companies that started to talk about it, I'm not going to mention any in particular, but if you go through the list of the ones that started to cite AI, some of it just doesn't even make sense. Like, what are you going to use AI for? Right? So I think people thought this was some sort of magic bullet. It's not going to be a magic bullet in the next 6 to 12 months. Yes, it will transform industries over time, right? And I've said this so many times. It will transform industries over time, but themes are 2 to 5 year things. They are not things that you do on a quarterly basis.
Well, this is a 10 to 20 year theme. Like we can all agree on that, much like mobile was, and the whole broadband, all these things that we get it. We don't mean to poo-poo them as a technology and what they're going to do to companies and their processes and all the like. It's really how the market reacts to them, Guy. Right? Isn't that kind of the thing that you and I we've been fortunate to see lots of different cycles, and the mother of all cycles, which is not too different, was that basically the switch to the internet, and how in 1999 you could have been saying e-commerce, internet, e-commerce.com, this or whatever, and there would be tons of skeptics saying that's never going to work. That's never going to work its way into, you know what I mean? But you would have been a fool to do that. But you could have looked at the stocks, you know what I mean, and said the stock market valuation doesn't work, or the, you know what I mean, like relative to this, that, whatever. So that's where I shake out on that.
I agree. Listen, the fact that John is writing about this, and a 51% increase compared to in terms of mentions, I think what you're going to see now is, I think mentions will probably remain the same. I think that we're going to see diminishing marginal returns in terms of what it means for stock performance. So again, companies mention AI in the call. Seemingly, the stock goes from negative to positive in the snap of a finger. I think those days, in my opinion, are probably over, and I don't think you're going to see the knee-jerk reaction. So the mentions will be there, the stock reaction won't, Dan.
All right, little housekeeping here really quickly. I think we did it on our Tuesday market call. I know that you guys referenced it yesterday, Guy. Look at that right there, the Battle of the Bonds. It's from our fine sponsor, CME Group. You have until tomorrow at 5 p.m. Central Time to sign up. They're giving cash prizes. This is a bond futures trading contest. The first winner, I think, gets $2,500 in first place, second place $1,500, and third place something less than that. But we are doing a bottle giveaway, a market call risk reversal bottle giveaway for those of you, the first 100 today who go and sign up. I think we already shipped, or we're going to ship 100 of these things from the other day here. You go to the cmegroup.com/bonds challenge. Okay, it's a paper trading contest. You just have to sign up for it, trade the as much as you want between September 10th and the 15th, and the winner gets those prizes. But you can be a winner by just signing up, taking a screenshot of your registration, emailing it to contact@riskreversal.com. Okay,
blow up Amanda's email or whatever.
Blow it up.
What kind of bonds?
Treasuries, T-bills. I mean, there's a whole list of bonds that you can trade them as much as you want, as little as you want, but the winners get those three prizes, the top three. And then you can just be a winner by going up and signing up and getting one of our tricked out water bottles. So that's that. Thanks to CME Group. So, Guy, take us out here, man. It's always fun to have EY. It
was fun. We got a lot going on. It's hot here. It was great. Yeah. Listen, the fact that the NASDAQ invited us, we rang the opening bell this morning. That's a pretty cool thing to do. So, and I think we put out an earlier picture of 17 years ago what some of us looked like when we did similar. So I don't know if you put that in the show notes, but that's crazy because, I mean, I haven't changed a bit. Yeah. Don't change because, well, you know what? Be yourself, right, Elizabeth? Isn't that how it all thing works?
Be you and be it well.
Yeah. Well, that's
nice. Exactly. Because you know why? Because everyone else is taken. But I want to thank our sponsor, SoFi. Dan, get your money right all in one app. FactSet, financial data and analytics powered by Tomorrow. Tomorrow, of course, being Friday, you won't hear from us, but we got some things in the cooker, as they say, where you might actually start. What'd I say?
No, in the hopper, the cooker, whatever. You know what I mean?
Hopper, I don't know.
Yeah.
Hopper, by the way, is obviously the sheriff in that great movie, that great series, Stranger Things. Oh, yeah. I like Hopper. He's a badass.
You watched it? Hey, really quickly, I hate doing this on a day that we have one of the finest strategists that we think exists on the markets. That would be you, Liz Young, on with us. We got to tease that tomorrow on the tape is going to be Savita Subramanian. You love Savita. She's the best. She's great. Yeah, I've seen you on a panel with Savita before. You guys, she's great. I've known Savita for a long, long time. She actually used to work on Rosie's team in the lead up to the financial crisis. That's where I first met her. So Savita is going to be on with us today. That's dropping tomorrow on the tape podcast feed. So check that out. Liz and Guy have a very special Monday edition of On the Tape that will be dropping this Monday. So if you just haven't had enough of Liz right now, get more on Monday.
Give it a few more days.
Yeah, there you go. So we got a lot of stuff going on there. All right, Guy, thanks so much.
We do. Later, peeps.
All right, thanks, everyone.